ask the first panel to take its positions. Mr. Keuning and Philippe Onat, Freddy van der Spiegel. Ah, he's there. Ja, meneer Keuning misschien hier. Ja, Ferry nog niet. Ja. Ferry, in very good shape, yes. Well, dear guests and participants, I give the floor now to Stephen Keuning. We know him already for a long time as a Director General at the ECB. We all know that the ECB has a key role in this whole problem of new financial framework and a framework that can serve the real economy. So we are looking forward for your comments. And afterwards, I give the floor to Freddy van der Spiegel, who will moderate this panel. Thank you.
Thank you very much, Guido, and thank you very much for inviting me to this, I think, very interesting conference. I was just looking at the logo of this conference, and I think it reminded me a bit that you remember that a couple of weeks ago, suddenly after a bit of a chilly winter, we had spring in the air and some green shoots sprouting up, and I think that we were already prepared for a nice weather early, but that was, I think, too premature, because afterwards we had again some frosty periods and snowstorms. And I think this is probably a bit symptomatic that we should not be deceived by a few sun rays, but we should always be prepared for adverse conditions, both concerning the weather and concerning the state of the economy. Yet I'm fully confident that you chose the right logo, and that I think in due time we will have spring in the air and perhaps a splendid summer. But I think this structural issue that we should be prepared is, I think, the main theme of my presentation. Now, do I have to press something to get the next one? Ah, yes. So we had as the theme of the first session growth and stability, and I would like to take a somewhat longer term perspective, which I think also the previous two speakers have taken, because it's essential to repair the structure and the architecture of our European economy. And interestingly, I think we didn't coordinate at all our speeches in advance, but I would also say that when we speak about growth and stability in a context of the EU or of the euro area, we should do it in the context of financial integration. I think that's, of course, the aspect which comes into play, and where I think that we should have also due attention paid to. I would then draw some supervisory lessons from the crisis, and I would then focus my presentation because I think yesterday there was this agreement, and I think it may be nice for you to know how we are working within the ECB on preparing for the single supervisory mechanism, and what are our guiding principles, the key success factors, and the challenges that we see for the future. And I'm sure that the panel will be able to touch upon various other elements of this theme, growth and stability. Now, just to recall, I think this is probably very well known, that when you talk about an economic and monetary union, growth and stability is very much linked to financial integration, which implies cheaper and cross-border payments, which of course should enhance cross-border shopping, competition, and thus economic growth. A larger variety of financial products should be available at lower costs or a higher remuneration, which again should be conducive to growth, and I think there's still a world to win here. You may have more buyers and sellers on larger financial markets, which should enhance stability. You would certainly have an enhanced transmission of monetary policy decisions, no longer the fragmentation that we currently would see. And you would, of course, expect from me, I say, that this enhances both growth and stability if you have a better monetary policy transmission. However, if you have this in a situation of financial integration, you have certainly the possibility for more cross-country distress contagion, and we have seen that throughout the last couple of years. And also importantly, that excessive risk-taking has a larger impact. So there will also always be excessive risk-taking, but it has a larger impact when you have a financially integrated system, and that's why you have to also enhance your supervision at the same level as you have this financial integration in the EMU. Now, very briefly, what are the main supervisory lessons from the financial crisis? I think there should be even more a willingness to act in a timely and adequately strict fashion. Of course, I also emphasize the word adequately here. There's a need to test resilience to truly adverse stress test scenarios. There's a need for independent supervision, avoiding local capture. There's a need for stronger risk-based capital and liquidity requirements, and again the risk-based is the key word here. More focus on verification and monitoring of compliance with best risk management and internal control practices. The cross-border dimension is of course crucial, which should lead to minimization of home-host conflicts of interest in a crisis, and I'm afraid this is also something we have seen recently. Harmonization of risk and asset quality assessment, which is a key factor. And last but certainly not least, a stronger interplay between macro and micro-prudential supervision. And this is precisely also in the regulation on which the agreement was reached yesterday. And I think this is really a key factor going forward. Earlier macro warnings and earlier spotting of contagion risk. Even if everyone seems to be doing fine individually, it's not ensured that we're doing fine collectively. Now, what is the rationale for the single supervisory mechanism? I think indeed the SSM will of course be only one component. I certainly very much agree with the previous speakers, but it should promote sustainable growth through financial integration while containing financial instability. So the financial integration gives you the benefits, and you have a less risks on the losses through financial instability of cross-border contagion through a good single supervisory mechanism. It will improve the functioning of the economic and monetary union, and possibly even wider, through a smooth monetary policy transition and functioning of money markets, and containing the imbalances that we have seen. This is again the macroprudential tools which are essential in this regard. It should help breaking the infamous negative feedback loops between governments and banks. Of course, I should certainly say that here we also need the single resolution mechanism, on which again the previous speakers already alluded to. It should remove any national bias of national supervisory authorities. An element which I think is maybe a little bit underrated, but of course, having been in the ECB for a long time, this is what we always see. You typically converge to the best practice. If you have many diverse practices, you converge to the best practice of the national supervisory practices, so that in itself should already enhance, I think, the quality. And of course, needless to say, that it would also be a reduction of the supervisory burden for cross-border banks, because now you're sometimes confronted with 17 different mechanisms, and in the future it would be a single one through the single supervisory manual, and that work has already started, and I come back to that. It should also reduce the crisis coordination failures among national supervisors. And finally, I think I should certainly emphasize that it should also promote a reinforced coordination by the European Banking Authority. So these are, I think, a relatively long list, although I even only took the main ones for why a single supervisory mechanism, in our view, is indeed the right way forward. Now, what is the state of play? And you will immediately see that this slide is already a bit too negative, because it still said that the trilogue should be concluded in a few weeks. So I think it underlines what Mr. Van Rompuy said, that contrary to what many people say, that sometimes the decisions are even going faster than many observers think. Nevertheless, we still separated from the executive board of the ECB. Very importantly, it should be established as a system and not a college. It is really a federal system, so it's one system. Of course, we have the participation of the national competent authorities, which is absolutely key, because there is the experience, there is the expertise. We are only building up this from now. We never had this responsibility, so we duly take account of this expertise, and we really would like to benefit from it, but this is a system. Leveraging this expertise, as I said before, converging towards the best national practices, and we may directly supervise the systemic banks, but nevertheless we have the possibility also to supervise a smaller bank when there is an issue and when we think it's not done properly. And it will be financed by the supervised entities, which would also create a level playing field across the EMU and beyond, because currently, as you very well know, the financing is very uneven across countries. So this should create a level playing field for all financial institutions. What is the key success factor? I think first and foremost the full and smooth cooperation between the ECB and the national competent authorities through joint supervisory teams, but also through strong horizontal functions. And I think this is one of the elements where really the capacity and the current merit of the ECB comes into play, because I think we can really contribute to the horizontal function. That's where we have our experience, that's where we can bring in really a novel value added to the whole SSM. A homogeneous approach to risk and asset quality management, of which you will also benefit substantially, and supervisory requirements, which is also, of course, something related to reporting. I'm sure you are keenly aware of the reporting burden you have. We should also harmonize this reporting burden across Europe, so really have only one reporting burden, which you can then do as efficient as possible. Both on and off-site supervision will certainly be part of the new framework. Of course, needless to say, we need an effective workflow management, because all these draft decisions will come from a national level to the ECB, and we have to process them extremely quickly and related to IT systems. Last but certainly not least, I think this is maybe my main worry, is the smooth management of the transition period. Well, this is, I think also you said you had hundreds of change projects in your bank, so this is bread and butter for you as well, but certainly for us as well. Of course, the advantage is we have done it before. We've introduced the euro, but now I come to maybe the main challenge. The main challenge is not so much the transition period as such, but it's the time. And here I would like to recall that we had 4 years to set up the ECB. We have broadly 18 months to set up the SSM, while I think it's a project of an equal magnitude. We should not underestimate what it takes. So this is, I think, a nice challenge for all of us to indeed be more efficient than last time and do it in 18 months instead of 4 years. Second main challenge is really to get all SSM institutions, all these national supervisors, all these national competent authorities aligned towards a truly European system. Well, I'm personally very much involved in the preparatory activities. This is the thing which thus far has surprised me to the positive the most. We really are working in an excellent cooperative spirit. I should not conceal that it's better than we had expected at the ECB. We are really working together very well, but this is, of course, we need to keep this up, because this is absolutely essential, because we need effective reporting lines and the commitment of resources. And this is in a sort of a federal system, is not straightforward. Use the national experience and skills while developing the ECB's horizontal and specialized expertise. We have now also quite some experience in risk assessment, but of course more from a macro perspective on our own balance sheet, but now we should also build up more the risk assessment. Also from the country missions we have some experience, so we have already some experience, but we should now utilize it also for this new function. But it's certainly a challenge compared to setting up the ECB, is there at least you had a single objective, price stability, which was at some stage very well quantified, and everybody can understand what it means, and we can be accountable to the outcome of that. That is lacking, of course, in this case. But I really would like to emphasize that the objective cannot be no bank failures. Because then I think we will not meet that objective. It's not even what we do. It's more the orderly bank. If there's a bank failure, it will be orderly, and it would not endanger the financial system or the financial stability of the system. It would also mean, of course, supervision is much more micro and not so much macro. So it would certainly mean that we would have, as an ECB, more visibility towards the national public opinions, which again is something we have to get used to, but we are already preparing for that. also our communication department is very much involved in the preparations. The advantage is reaping synergies between the central banking functions and the macroprudential supervision task, as I already said. Staff recruitment, relocation, maybe language issues will come up. We never had this. We are only in English. Training, of course. A smooth yet rapid transition is, of course, key. I think we will need a couple of years for this, but of course we should avoid that we simply replicate the national practices which still remain diverse. So this is really, we do not want to destabilize the national systems. We don't want to destabilize you. We need to swiftly change, but nevertheless we should be aware that we cannot do everything in one go. So this is, I think, a real challenge. And last but certainly not least, but this is just a replication of what others already said, we are firmly convinced that unified supervision needs a common resolution mechanism. Thank you very much.
Thank you, Stephen. As usual, your presentation is at the same time to the point and comprehensive. Of course, you set the scene for, let's say, the stability element of the discussion. I think now the task of the panel is to see whether with this stability framework we can now go for growth. So that, I think, Freddy, you will have to find out.
Thank you, Guido. Indeed, ladies and gentlemen, it's a pleasure to be chairing this panel. The title of our discussion, Growth and Stability, Can It Be Combined, is an interesting question, but also a very tricky one, because economists in centuries are disputing about this combination, possible yet yes or no. It's, of course, things where economists are specialized in to continue to dispute. There is one extreme school saying free markets are making progress through trial and error. The progress leads to growth ultimately, but trial and error means that sometimes there are errors, and errors lead to market corrections, which can occasionally lead to instability. But that's the price to pay if you want progress and if you want free markets. That's an extreme school, creative destruction, and all these economists adhering that idea. The other extreme is to say financial markets are intrinsically unstable, and instability can destroy the economy and can destroy society. So you need a regulatory framework, you need coordination, and you need public intervention to maintain stability, and that's the price to pay in democracy, and that's then Minsky and the others. And perhaps the answer is that you need a combined approach where you allow some instability or volatility, what Stephen also mentioned, but that you can identify where the instability becomes dangerous for society. And then the question is, of course, which of these three solutions are there, and is Europe able to find the right balanced approach? I must admit that, honestly, I think that the track record of Europe in practice until now is not very convincing. If you look at the experiment of the Greek bail-in, it created huge instability in the sovereign markets, and the experiment with the Cyprus solution taxing deposits is, of course, undermining confidence in the banking system. So this is not very encouraging if you look at the practice of Europe. Now, I'm very happy to be a chairman, which means that I don't have to answer questions. I just have to ask critical and sometimes provocative questions. And we all know that one fool can ask more questions than 100 wise men or women can answer. But fortunately, we have our panel members to provide us with the questions or with the answers. And I would like to ask each of them to give some introductory ideas. They each come from different backgrounds. We have Pedro, Rodeia, who is with McKinsey. We have Francesco Mazzaferro, who is head of the Secretariat of the ESRB. And we have Pat McArdle, chairman of the EBF Economic and Monetary Affairs Committee. Please, Pedro, could you give your initial thoughts on this very interesting issue?
With pleasure. Good morning to all of you. It's a pleasure being here. My answer to the question, is it possible to balance stability and growth, is yes. Yes, as long as Europe as a whole grows. because banks themselves can only grow as much as the economies. The health of a banking system is usually a proxy for the health of an economy. And I will share a bit of a more optimistic view, which can happen if everything that was said before happens in a reasonable way, both from a regulatory and from the management of this circle between sovereign and financial dimensions. In the absence of catastrophic scenarios and under reasonable regulation, we have looked at the growth of about 164 countries in the world in terms of banking system. And if we look at Europe, and if we take a long-term view like the previous speakers, we think under that scenario, European banking revenues would grow about 4% a year. Now, before you start celebrating with 4%, remember this is a nominal number. So in a sense, it's not much different from the expected GDP nominal growth, because the revenue of a bank is a nominal variable. So it doesn't seem very exciting, but under normal circumstances would be a reasonable development. The way we get there is that we expect the improvement in margins in deposits once rates go back to normal. We're talking 2020 projection, to be compensated by the decline in loan margins, and as a result, essentially, we are saying this comes from expected volume growth of about 4% a year. Now, as an aggregate, remember this includes Eastern Europe, the question is how can we do that while deleveraging? And the answer is that there are enough pockets of growth if we look granular enough to find this ability to grow the economy and the banking system as a whole. So if we can just show the first chart, I'll just share two charts with you on this granular view on growth. The first view is a geographic view. You may say, well, 4% as a whole, but if you take red being more intense growth and blue being colder growth, you can see a very wide disparity of what we expect. And the numbers you see in the bubbles is essentially how much are we talking about in absolute terms in revenue growth. This has a lot of assumptions that I'll get to later, but essentially it means even if on aggregate we can get some growth, it's a very binary situation between different types of countries. But more importantly, if we take one level lower, which is to say, okay, let's look at countries but also customer needs and types of products. If we can look at the next chart, what we see is that even in the economies which will be expected not to grow significantly, there will still be growth spots. The growth spots are the greens and to some extent the blues. And so our point of view is within the banking system, if you look granular enough, you find growth opportunities. You find naturally some countries, particularly in Eastern Europe, are more likely on a convergence play, assuming a reasonable economic context, to have more growth pockets. But even in the least growing markets, there will be growth pockets. And we actually think the most important of them in many markets is deposits. From a growth perspective, revenue growth, as the economy gradually goes back to normal, deposits will become profitable again. Right now, deposits are not profitable for most banks. That's a fundamental issue of the system, particularly in countries where there are no fees and it's free banking while in credit, because essentially it means banks make a loss in more than 2/3 of the customers. As rates go back to normal, hopefully over time, remember we're talking towards 2020, there would be growth pockets, and the growth pockets would include deposits. Now, this leads to the first condition for this 4% growth to happen. We need depositor trust. Without depositor trust, nothing can save the system. Society for a large extent has lost a lot of confidence in banks. If now they lose the confidence that their money is safe, it is a real disaster. So I'm actually quite worried about anything that would damage this perception, because it's a perception that can change very quickly. And yes, over 100,000, and yes, for certain types of bondholders, that's a different story. That's a different type of investor. You can think about wealth taxes, but for the poor person who has 1,000 savings accumulated over a lifetime, it's something sacred that we cannot allow to be touched in any circumstance, on my view, because the impact on the trust in the system is much higher than whatever other benefit we can think about. The second condition is that banks themselves have to become better for customers. I personally think there would have been no crisis if banks have stayed very close to customer needs and not finance activities that were not essential to customers, including speculation or buying assets that were actually not needed. So going back to customers, making their life simpler, helping customers have a better management of their financial needs is actually essential. And a lot of it is through simplicity. The banking system in Europe and around the world also is not simple. It's difficult for customers to understand. It's difficult for bank employees to understand. There's a lot to be done to explain it to society, make their life easier. And finally, we need to ensure, and that's why the regulatory outcome needs to be reasonable. And even if each individual legislation is reasonable, we need to look at the aggregate impact vis-à-vis what Asian banks will face. If you look at taxation, Singapore, if certain banking jobs, high-quality banking jobs would go to, say, Singapore, those people would be paying 10 to 15% tax on their income. The bank itself would pay much lower tax, would have much more benign regulatory environment. So the question is, where will the next trading room go? So in the whole, we need to create a regulatory setup that allows banks to at least cover cost of capital. Now, even with the 4% revenue growth, we think most banks will struggle to cover cost of capital until 2020. And the question is, where is the capital going to come from to an industry which is not able to cover cost of capital?
Thank you for your very interesting remarks and for your question at the end of your introductory remarks. May I now ask Francesco, head of the Secretariat of the ESRB, to give his view on these issues?
Thank you very much for the invitation. I would like to say things which in many respects are complementary and additional to what we have just heard. So if you go in the US, the terminology which is very often used for banking is banking industry, which means it is an industry, which means it survives if it makes money. And this is important because you can look at industry very often from different perspectives. For example, normally the perspective in which I see it is a different one. I'm in a central bank, so banking is part of the transmission mechanism. You need banks because if you do not have banks, monetary policy does not function. I am part of the European Systemic Risk Board, so of course I see banks in particular as propagation of systemic risk, of contagion. But if we are completely fair to ourselves, the real question is the banking model, is the industry able to make money or not? Exactly what you were saying. Because if we were speaking of a different industry, imagine we were speaking about the car industry. Imagine we were in a situation where since 2007, the business model has been fundamentally hit, where you would not have access to raw materials, where you have big problems in the production, and this type of things. Of course, you would have at a certain time entry and exit, and you would have a fundamentally different landscape. So one of the questions which one has to ask itself, why is this not happening, if not in catastrophic situations where there is the IMF entering and imposing a fundamental readjustment and so on. Of course, this is to a very end not happening because you have two systems supporting the status quo. One is a mechanism of implicit subsidies, which exist due to the too big to fail. There are studies even to a certain extent which try to quantify this type of subsidy. And then, of course, because you have a support of monetary policy, which is creating in extraordinary form the way for the banking sector to function in terms of monetary transmission. But of course, we have to caution ourselves against the expectation that this is a permanent situation. We have to ask ourselves, I mean, if I well understand, we are back to growth 2020. If you were, I come from a car town, from Torino. If you're going to a car industry and say you're back to growth in 2020, the guys will be a bit worried. And if you were showing to them a slide in which you say there is some green and maybe with cars not good, but maybe with some motorbikes you could be able to make some money, the people would be terrorized. So it's very important that we collectively reflect about what does mean. Now, I understand from the end of the speech of the chairman of the EBF that there were two scenarios which were designed for the books of future historians. But there is also a third one which has already been written, which is the Japanese scenario. And of course, we have to ask ourselves whether, I mean, when I was studying, everybody was saying that we should follow the Japanese model. Bookstores were full of books about the Japanese model. Now, the books have disappeared, but I fear that we are in the model without knowing it. So we have to be very, very clear on what type of risk we are running. Which basically means also that the industry has to rethink its own attitude to regulation. Because at the very end, I'm sorry to say, to read the article of Martin Wolf today in the FT, we have not been discussing so much about Cyprus, maybe because we are under shock today about what is happening. Read the book of Admati and Helvig, which is quoted. That is one of the most pleasant books I read in the last years. Martin, he's the deputy chair of the advisory scientific committee of the SRB. So at the very end, the industry cannot be in a situation where it is at permanent risk because of low level of capitalizations. This is something which other industries would never tolerate. If you go to other segments so if you are in industry like other industries, at a certain time, you have to reason in industrial terms. Thank you.
Thank you very much, Francesco. Pat, can you add some comments, please?
Hello? You can hear me? I have a few slides just to put some structure and have a different approach for a minute. I will go through them rather quickly. In this one, I just note for background that the Tier 1 capital ratio of banks was 7% in 2008 and is now around 10%. The second fact I would note from it is that the non-performing loans of banks was 2.6% and is now 8.4%. Then there have been crises. I think this is 19 of the 27 countries, according to the IMF, have had banking crises. If you go back a few years, there was a major difference of view as between the impact of regulation on banks and on the economy generally. I give you here a few quotes to refresh your mind on this. The banks, as represented by the IIF, had one approach, and the authorities, as reflected by the BIS, had a very different one. Perhaps the best quote there is the last one, which is again from the Basel Committee on Banking Supervision. A key gap in our knowledge is on the influence of lending on real economic activity. I suppose we're all more humble now And maybe the answer is somewhere in between. But I think most of us, if not all of us, would accept that there is a connection between bank credit and the economy, number one, and number two, that bank regulation in the form of increasing capital, which was necessary, in my view, also had an impact on bank lending. So as usual in economics, the picture is grey. It is not black or white, and the answer is somewhere in between. The question is how to strike a right balance. Just on last Friday, the IMF performed the first ever financial system stability assessment. By the way, let me say, one of the things we have now is regulatory clutter and also acronym clutter. It takes, every report has about 2 pages of acronyms now, and there would probably be a prize at the end for anyone who can meet a test as to what the various ones mean. So perhaps this would be my first recommendation to the authorities. We really need to simplify things, I think, a little bit. But anyway, this one here, I thought these conclusions were interesting. Economic growth is likely to be anemic. There are very few who would dispute that at the moment. And it is, the risks, therefore, to the financial system remain elevated. Urgent action is needed to adequately capitalize the banks. We have seen that it is well underway, and we have heard some discussions earlier from the President about it. It is a question, I think, of degree and what the final target should be. We also need a shared system for closing down and restructuring, which has been, is generally accepted. And finally, regulatory and policy uncertainty and gaps in policy frameworks also continue to pose vulnerabilities. And I suppose maybe that's the one that I would like to emphasize. Continuing in this vein, in somewhat greater detail, banks have recapitalized, partly through deleveraging, was the conclusion. So I come from Ireland, and where we have seen much deleveraging. So there is no doubt that certainly in some of the programme countries there has been very substantial deleveraging, and indeed there is no doubt that, and I'll come back to that in a moment. I want to move on now. There's no doubt that that is necessary, but I think there has also been in the EMEA in 2011 to try and shed some light on this relationship between credit and economic activity. I'm doing okay for time, Chairman?
Well, if you can...
I can see you getting anxious. Okay.
Yes.
Finally, we will wrap up. The correlations between bank credit and real economic activity have increased. This was the result of a macroeconomic econometric study. In most countries, we found a causal relationship from GDP to credit growth, which is interesting. No evidence was found for a unidirectional relationship from credit to growth. Although, of course, there were some examples, such as indeed in my own country, when exuberance reaches a certain level, credit effects do become apparent. But the ultimate conclusion from this study was that there would be no recovery without bank credit. Now, given the conclusion there that the direction is between demand for credit comes first, I think what the conclusion I draw from that is that banks will not be a driver for growth. They will respond to demand for credit in general. I want to look, there are major problems left, that is evident at this slide here, which shows basically the cost of borrowing to a corporate. And you can see that spreads have widened. In some countries, a loan of up to 1 million with a maturity of 1 to 5 years costs 7%. In others, it costs 3.5%. This is an intolerable situation. So this situation has not been cured by increasing bank capital. It has not been cured by OMT. The question is, what will cure this situation. I suspect possibly part of the answer is banking union, which is why I'd be a strong advocate of banking union. It really is needed for this. And finally, Chairman, you'll be glad to hear, the last slide I have here is merely a warning, which echoes with that of the president of the EBF earlier, is the pendulum effect. I spent half my life in the public sector and half in the private sector, so I have observed it. I think there is no doubt, and it is not emphasized enough, supervision was a contributor to the crisis in a fairly major way, inadequate supervision. The banks, of course, bear their own responsibilities for it, and we accept that. But the risk now is the pendulum effect. Having been too light, the risk is you go to the other extreme. The challenge, and I leave you with a challenge, not a question, is to find the balance in the middle. Thank you.
Thank you very much. I would like to ask the panel members and the speaker if they have any direct reaction on the things that have been said in the meantime.
Well, I can just say a few words, of course, mainly also focusing on this last slide, which is, of course, what we all want to achieve. In this regard, I would really like to emphasize that this single supervisory mechanism is not more regulation, it's better regulation. And in this regard, it will also be interesting to see how many non-euro area countries would like to join. Because if you can still see it's a regulatory obligation for the euro area countries, I have the impression that there are quite a number. Of course, we know one euro area country who would not join for whatever reason, at least. But I think there are quite a number which are seriously considering to join, which of course would be an indication that if you join it voluntarily, that you think that it is indeed better regulation and not more regulation. So that's my first point. The second point, I think, is again coming back to this confidence effect, which I think is absolutely crucial, which Pedro also mentioned. And here again, so if you strike the right balance, of course I'm surely in favor of that, then you can enhance confidence, and through that indeed have the cross-border lending picking up, because I think that's the fragmentation which we currently see. The other, I think, very dangerous slide which you showed earlier. If confidence then picks up and cross-border lending picks up, and the financial integration comes back without the risk of financial instability being so enhanced, then I'm confident that that will in itself lead to much growth, because it's a bit absurd that the growth opportunities in the countries with these high interest rates would be much lower than they are in Germany or France or the Netherlands for that matter. So I think it's really this financial integration which should resume, thanks to the confidence being reinstated. And in that regard, I think this is an essence where I think we all can contribute, both the private and the public sector.
Maybe to build up on that comment on supervision, I do agree that the key is better supervision. Even with all the new regulations, you can have two banks with exactly the same numbers, exactly the same leverage, exactly the same capital, exactly the same. On paper, it's the same. One has a very good credit culture, very strong risk policies, very good risk decision making. The other one doesn't. The second one will fail no matter how much capital is against it. On paper, they look the same. You need to see inside and see if the decisions are right, if the portfolio is strong. In addition, we think that the single supervisory mechanism is important, and it should ultimately cover all banks. We are worried about too big to fail, but we are also worried about too small to survive. In many countries, the weakest institutions are the small ones. I mean, take the US. How many banks fail per year in the US? This is the country that is most worried about too big to fail. Yet, 200 to 300 banks fail every year. Some banks have, some of the countries that have the most resilient banking systems have 4 banks, 5 banks, Australia, Canada, Brazil, South Africa. They had 4 or 5 banks. They did fine. China has 4 large banks. So actually thinking about too small to survive is also important, because ultimately you need institutions that the public can trust with their money.
Francesco, if you have anything to add?
Well, very, very shortly, one additional point I would like to make is that whatever adjustment will of course be very difficult by the degree of imbalance from which we are starting. So we have to reflect on, or maybe to say in a different way. If I had been reading what I read from Stefan Cecchetti, who is the head of research of the Bank for International Settlements 10 years ago, I would have thought this was a radical extremist who is writing, is anti-Occupy and this type of things. What Cecchetti writes is basically that they find evidence, and strong evidence, that the banking sector, when it is oversized, creates problems to growth. And there is a recent book of Adia Turner, who has been an excellent boss of the FSA, just published with the MIT, which says the same. So this is, when we are discussing the issue of banking and growth, we have to start from the fact that we are not in a normal situation. So we are not in an equilibrium, and probably we are even in a situation which economists call multiple equilibria, where different solutions are possible. We are in an economy when your chairman was saying that the balance sheet of banks reproduce the balance sheet of the economy, this is true, but it's a problem. It is unfortunately not part of the solution, it's part of the problem, in the sense that we have a growth model which is too much based on debt. And whether this is public debt or private debt does not make a great difference. If you have a debt overhang problem, this is extremely difficult to solve. The leveraging from this point of view is overdue, but it's also extremely difficult, because we are not discussing about minor things. So it is something which has to be discussed. It's something which has to be identified. The difficulties which we have been seeing with Greece and Cyprus reflected the objective difficulty of the problem. Cyprus has an unsustainable business model for banks. This is the reality, and then of course it's extremely difficult to explain to the public opinion. All in all, it's not surprising that these things happen, because we are in a very difficult situation.
Okay. But
I would just add, going back to your original question, I think we've decided a long time ago that untrammeled capitalism is not ideal. So otherwise, why do we have the various supervisory and regulatory mechanisms that we have? The problem, as was mentioned earlier by some of the first speakers, was there were flaws in the design of EMU. The Stability and Growth Pact was not enforced properly. And when it came to bank supervision, supervision was lax, not just in the United States, but in Ireland, in Belgium, in Germany, in many countries. There were major deficiencies. In fact, we had a debate for 10 years. The ECB always wanted to take on supervision, and I recall many in 2002 and 2003, I think, when the ECOFIN would routinely issue a statement saying the supervisory arrangements are adequate and we are happy with them. We have had made yet another study. There was always a problem lurking there, and we debated it many times, and nothing was really done about it until, of course, in Europe we had a crisis. So my answer to your question is yes, the answer will be in between. Certain controls are necessary, and I end with my last slide, which is we must beware excessive capital requirements and excessive regulation, because that can be harmful. And if you ask me for my opinion as to where we are, I think we're tending towards the excess.
Mm-hmm. Okay, we still have time for one or two questions from you, the audience. If anybody wants to react or has a specific question. Yes, please, Rudy.
Thank you, Freddy. My name is Rudy Bonte from the National Bank of Belgium. I appreciated very much the comments made at the end by Mr. Rodeia on credit risk culture. And I think this is important because we can discuss a lot about regulation and the regulatory tsunami, but this is not effective if all these new initiatives are not completed by a more prudent risk approach. And this brings us to the issue of culture. Risk appetite. And then my question is, are we sure now that all banks have changed their behavior and that this is reflected in the way they see their future activities and the way they look at the sustainability of their business model? Is this a difficult question? I don't know.
Yeah. It's not addressed to someone specifically. Does anybody wants to react on this question?
Yes, it's of course, I think, a vital question which I will not address from the banking sector perspective. I leave that to someone else. But it gives me a nice opportunity to also come back to this issue about over-regulation. Because if in the past the supervision was a little bit too administrative and just filling tick boxes, then it could even be that a more risk-based, which I think you're emphasizing, a risk-based supervision, would to some extent even be lighter than a heavy, let's say, administrative burden, lighter and better. So, okay, maybe it's too optimistic, but I would certainly not rule out. But I think the essential aspect is what Mr. Bonte touched upon, is to go towards a more risk-based assessment and maybe a less administrative assessment. But this is then more from the supervisory perspective.
Mm-hmm. Now what I have observed directly is many banks are investing and are investing in training, in communication, getting the right people in the right places to improve the risk culture. But with two observations. First, I'm not certain that all of them are doing it in a sufficient way to ensure robustness. Second, this is a very long journey. And it's a long journey because it's about changing mindsets, it's about changing incentives, it's about changing systems. It's a very complex issue to tackle, and the proof will be when we grow again. Because I think for the time being, banks have been more prudent than before. But what I observed in the past cycle, and over the last 25 years, is when you start growing very fast again, the pressure for banks to follow the crowd is very strong. And to be able to say, well, everybody else is growing results very fast. We are getting hammered by the financial markets every quarter when we announce results for having weaker performance, just because we want to be the conservative ones. That's when it's really difficult. Actually, it's more difficult at times of growth. So I think for now, in most situations, I see a clear improvement in risk culture, but the proof would be when we grow again.
Okay. Francesco, last...
I wanted, in fact, to ask a question to you on this, because when you have been showing...
I think we are running slightly out of time, so...
When you have been showing the graph of Europe, I thought it was almost the contrary of normal weather forecasts, because the very red one, instead of being in Madrid, was in Siberia. Now, when you are forecasting growth in Ukraine, how do you, a place where people have been losing awful lot of money in banking, okay? If it's sufficient, you read the newspapers in the last 2 weeks. How would you judge the culture there? Is it a place where people can go without losing their money?
I'll not make comments on specific countries, but I can tell you that we have this picture, which is before risk costs. We have the picture after risk costs. They are somewhat different. I have not shown it. If you're interested, we can share it later. But the risk component makes a huge difference, and I think risk culture is an absolutely key point, and making it stick for the long term when the opportunities are bigger than the resources, that's when it really makes a difference. And that's where I think that the regulators can make a huge difference. It's like a speed limit. We may lower the speed limit, but what's important is to go after the people that don't obey the speed limit.
Yeah, okay. Pat, your reaction?
My reaction to the question, I think it would be a very foolish person indeed who would say that all banks are behaving totally properly. And I'm old enough and cynical enough to realize that there are always some bad eggs in the pile. But the vast bulk of banks, I think, are perforce now behaving in a certain manner because they have no choice and because the circumstances are so bad that they're being driven in that way. So in a way, I might prefer to go back, I think, and focus on the title of today of this panel is Are Growth and Stability Compatible? And I suppose in the very long run, the answer is yes, but there are bumps on the road in getting there, right? And it's a difficult one. But for me, I suppose we are in a particular situation now where perforce balance sheets have to be repaired. So that has an impact on growth. So my answer to your question is in the short run, which could be the next 3 or 4 years, then I think that they're not. The answer is no, actually, in the sense that the recovery, which, as I see it, will come from sparked by demand. The question is, will the banks have the facility to fund and finance the recovery? And although there are no science to tell us what the answer to this question is, there must be a strong suspicion that they will not be able to respond in sufficiently robust fashion to finance a very strong recovery.
Mm-hmm.
Can I just make one final remark, which leads to the key question, which is, can we actually, why is credit not growing? And what can be done about it? I think fundamentally, credit is not growing for 2 reasons. The crisis made the outcomes for companies and for banks very binary. Some banks are really strong, some banks are really weak. Some companies in Europe are really strong, some companies are really weak. The strong companies don't need as many loans. They are cash rich. The weak companies, the banks don't want to lend them. It has relatively little to do with liquidity. There's enough liquidity in the system. Part of it is about capital in the price, but at the right price, most banks would be willing and happy to give a loan to a company at the right price.
Any other question? Yes, please.
That's very good what you just said. And my question
if you could introduce yourself.
Yes, sorry, Joe Faricawnia from the Export Capital. My question was going to be on what is being done to force the banks to clean their balance sheets right now. I'm traveling around a bit around the world, and what the world is very amazed about that the European banks are not forced to clean the balance sheets. They still have a lot of assets on their balance sheets, which they shouldn't have. They just have them because they say, okay, fine, the assets prices are going up. I'm going to stick with it for a couple of years more. And maybe I'm not going to make a loss on it. It means that, in the meantime, you got some capital which is immobilized. And this capital, if it was freed up, instead of having, risk-weighted assets of, 70%, for example, they could have do something else with this and lend this money. There is a lack of leadership there, and I want to ask you the question, who should be responsible to really force these banks to speed up the process, like the UK did it with RBS, like the US did it with the FDIC. They did a tremendous job. A lot of banks are going under in the US. You said it, 240 banks, the regional banks in the US every year, just because the FDIC is forcing these banks to dispose of assets and to close if they need be. So who should do it in Europe?
Stephen?
Yeah. Now, one of the elements which comes into play is this infamous nexus between the banks and the sovereigns, of course, which I think has played a role in not doing this forcefully enough. Because I think in agreement, which was Francesco said before, maybe there have been not enough closures of banks which were unprofitable, which of course would then clean it in a way that you would restart. And this would not be imaginable in any other sector or industry. So if we are able to break this link, and indeed also it's a little bit maybe a repetition, coming back to this idea about a common resolution mechanism, a safe, let's say that banks can safely go under for the system, and then the confidence comes back, because that's of course another element, then I think you can also be tougher on those banks which don't make it. And I fully agree with the earlier speaker, this is not necessarily the largest systemic bank, but there's also a lot of smaller banks which have then created problems and which now are maybe kept alive unduly. So I think it's a bit of a combination, but I think the origin is that this intertwinement between the problems of sovereigns and problems of banks have severely complicated the matter in Europe.
Yes?
Well, it has to be done. It's also a question of time, because I mean, if you do it tomorrow, you shock the industry in a way which is terrible. There is already a lot of initiatives which have been taken locally, because I mean, it's not that the supervisors are blind or stupid. So it's there is a number of asset quality reviews which have been done in countries, in the Netherlands, in the UK, in Italy, and so. And we would certainly very strong support a coordinated action with the EBA playing a role of having, setting the conditions and looking at the quality of the balance sheets. It takes time, because at the very end, if you do it in a way which is useful, it cannot be simply sampling with small samples according to statistical methods. It has to be something in which you have a common definition of NPLs, a common definition of forbearance. And I hope I will not preempt too much what Isabel is doing. There is a lot of progress which the EBA is doing this, and we support this very much. And so I think that there will be a lot which will come in the next months from their angle, asking the banks to, with the supervisor, accompanying them to do this work. Of course, it has to be done in order to strengthen the resilience of the sector, not to shock the sector.
I'd only add that in some countries, a lot has been done. In the UK, more than 75% of the non-core assets have been reduced. In other countries, the concern is more on the second-order effects of depressing the real estate market and the industrial sectors. But my view is that the longer it takes, the worse it is. So creating the right resolution mechanisms, creating the right solutions for bad banks to then manage these assets in a different way is good, because transparency always helps.
I would like to ask perhaps a last question, which is more about the design of the financial system as is conceived today. So you have a single supervisor, the ECB, and you have a new aspect of supervision, the macro stability supervision, where ESRB is playing a role, but where the key responsibility is still the member state, as I understand it. Now, the macroprudential is then going to the European level, but every member state is responsible for its own stability. Is there any idea how potential conflicts between macroprudential and microprudential will be resolved? European level, national level, or is the whole macroprudential supervision also going to shift, not only in advices and reports, but also in practice to European level, with, of course, the resources to do macroprudential things?
Yeah. Now, first of all, I think the regulation, the SSM, does give macroprudential tools also to the ECB. So I think that we should not underestimate. Nevertheless, I think many of these instruments are still national, because presumably they also need to be implemented nationally. Again, coming back to this very illustrative graph, which was earlier shown about the interest rate of loans to SMEs. Of course, if this is too low, you have to have a national, let's say, macroprudential instrument, which is different from the one which is in the one where credit is really not flowing at all. So, but this being said, there will be, and apart from the extremely useful role that the ESRB will play anyway, also in terms of concrete teeth, there is a possibility for the ECB to also intervene if they think there should be a top-up from the national requirements.
Yes, sir.
I'm absolutely on the same line, and to support it. What is, and by the way, here there may be a difference of perception and sensitivity between us and the banking industry. At the very end, it is also healthy that there are differences of views, because if we all agree on everything, it's fine. Reading your publications and reading your statements, your
supervisory system. And I'd look at the CRD4, which was recently agreed by the European Parliament, which focused on bankers' bonuses, a very interesting topical topic, and didn't deal with the defects in it, which there are many. It has been described as having more holes than a Gorgonzola cheese, for example. So my message would be, I think we really need to be aware of too complicated a system and too much national interference. Thank you.
Yep. My message is, let's look beyond Europe as well. At the end of the day, banks for growth in Europe will work if Europe grows and if Europe is productive. So let's make sure that we create the conditions for Europe to be productive in the world scene, and that we don't offer too many opportunities for regulatory arbitrage. Otherwise, the high-quality jobs will move to Asia and to the Americas.
Mm-hmm. Indeed, the world is not waiting for Europe. The world is moving, and that's a challenge for Europe. Ladies and gentlemen, I think this was a quite interesting discussion. We did not get all the answers on all the questions. I don't think that any member of this panel and the speaker has the ambition to know all the solutions. We are all looking to find a balanced approach, and unfortunately I think that the problem with the balanced approach is that also that is a moving target. Thank you very much to the speakers. Thank you for your attention.